Good morning, everyone. My name is Zachariah George. I am the co-founder and chief investment officer of Startup Bootcamp Africa, one of the largest tech accelerators on the African continent, and the general partner of a Pan-African seed fund called Launch Africa. I'm going to be talking to you today about the audacity of resilience, an entrepreneurial journey through living, loving, and launching things in Africa. And just a bit of perspective on what got me to this point. About more than 15 years ago, I was sitting at the Stanford Business School at a class called Global Entrepreneurial Management. And a professor called Randy Komisar, who is now one of the most respected VCs in Silicon Valley, said something that completely shook the core uh, the core essence of my business career. And he said, of all the risks we have in our lives, the most dangerous risk of all is the risk of spending your life not doing what you want, on the bet that you can buy yourself the freedom to do it later. So just pause in that for a second and think of whatever you are currently doing in your life and whether or not what you do is in complete sync with your head and your heart and your mind into your life's purpose and your vision. And often in life, we end up doing things for the short term. And we believe that one day, at some point in the future, when I have the time, when I have the resources, I can follow my true calling. And some of the most significant people in the world, not just successful, but significant people in the world, understand how to follow their true calling, their mission, their vision almost, and balance that with the practicalities of their work. And that's why, to me, building the future of venture capital in Africa with the right players is not just a job or a career, it's a vocation. And I'm here to share some of my experiences with that. So, just a little bit of context here. I grew up in the Middle East in a small country called Oman, a son of diplomat parents, an economist, and a teacher. Um, Studied engineering at the Indian Institute of Technology in Chennai, which is one of the top universities for engineering in the world, where the likes of the CEO of Google, the CEO of Microsoft, etc., went to that school. I then spent the next 2 years getting my MBA at Stanford in Silicon Valley, which is when I first got exposed to um, the tech sort of startup industry where the likes of Facebook and Google had first launched. And around that time, this was in 2003, 2004. I then spent the next 7 years of my life working as an investment banker on Wall Street after my Stanford MBA, where I did a whole bunch of things from mergers and acquisitions to um, global finance analytics, etc. And then when the Lehman bankruptcy happened, I happened to spend a few weeks in a small village in Ghana doing work in the microfinance industry. Came back to New York, was a vice president at Barclays for a while, and then eventually decided to come to South Africa. And in South Africa in 2010, apart from the fact that we had the World Cup here, I fell in love with the incredible business dynamic that where developers, designers, agencies, and creatives thrived. And I realized very quickly that Cape Town was the Silicon Valley of Africa. And I did not expect to be here for 10 years, but 10 years later, we've now seen an incredible growth in not just the venture capital industry, but the entire entrepreneurship ecosystem on the continent of Africa has grown by leaps and bounds. So just some perspective here on why this is so important. Today, the world's population sits at 7.5 billion, of which just over a billion, about 1.1 or 1.2 billion people live on the continent of Africa. However, within the turn of the century, which is the next 75 to 80 years, the world's population is projected to get to 12 to 12.5 billion. And what's really shocking to know is that Africa accounts for more than 85% of that population growth. So the question really is, in 75 to 80 years from now, when 1 in 3 people on the planet will come from the African continent, 1 in 3 people provide the access to market for any piece of technology in any industry, be it healthcare, education, biotechnology, commerce, energy, you name it. Do we in Africa, as industries, have the resources to support that? And what about our cities? What about the congestion? Solutions for urban healthcare, for mass transit solutions, for renewable energy, for agriculture, for sustainable food. So the question really is, can we develop solutions on the African continent that solve real problems, where there is a massive potential for growth, and where cities like Kinshasa, Nairobi, Lagos, Accra, and Johannesburg will become vastly, vastly overpopulated, far more than most cities outside of Africa, where in the next 60 to 70 years, 12 of the top 20 most populous cities in the world will be in Africa. Can we invest in technologies that make our cities, our towns safer, provide better ease for the use of renewable energy, for transactions, for financial transactions? And that is why the opportunity from a venture capital perspective is so large. And when I moved to South Africa 10 years ago, that's what provided me the right motivation to do so. So there's a massive opportunity from a global population growth perspective. And Africa has the tendency to leapfrog innovation. And you've heard this many times, from smartphone penetration to mobile money to prepaid insurance, prepaid calling cards to um, mobile phone technology. Africa has always been leaps and bounds ahead of its peers in certain industries because of necessity being the mother of invention. So let's look at what's happened on the continent of Africa over the last 9 to 10 years. So Africa is the world's fastest growing market, which will account for almost a third of global population by the 21st century turnover. We've seen a huge rise in tech hubs and accelerators, incubators, corporate startup collaboration, and unique tech adoption rates. There is still a really big gap in early stage venture capital funding across Africa. So when I moved to South Africa in 2010, the total amount of venture capital activity on the continent, as described by Series B, Series A, and pre-Series A investments, was only around $20 to $25 million, which may seem like, and not just seems, it is a very small amount of money. That has now spiraled to more than $2 billion in 2019. So from a pure growth perspective, we've seen more than 100x increase in growth of VC on the African continent, which is far quicker than any other geography in the history of venture capital. From 20 million in 2010, 2011 to 2 billion plus in 2019. Just last year alone, we've seen a significant number of venture capital funds all across the US and Europe invest in Series A and Series B rounds of funding, where they would not have played any active role merely 2 years ago. So we've seen not just an increase in the total amount of funding, but in the number of deals done, and more importantly, the number of repeat founders and the number of deals that have gotten co-investments from multiple VC funds. In 2019 alone, in fact, 91 African tech startups did funding rounds of more than $1 million or more from 192 different investment deals. The bulk of that funding, more than half of that, went to Nigerian tech startups. FinTech has played a massive, FinTech as always, which tends to be the top performing sector in Africa. No surprises, again, got the bulk of funding. More than half of the startups are less than 5 years old. There is a very strong, almost a fifth, in fact, more than a fifth of these startups were founded by women. And a lot of startups, this was their very first $1 million. So, the it has been a record-breaking year for African VC, with almost 100 deals, in fact, more than 100 deals in total for the year. And the key tech hubs on the African continent tend to be Southern Africa, but dominated by South Africa. In East Africa, Kenya, together with Uganda. And even though Rwanda is a very small country from a tech um, participation perspective, it plays a huge role also with the liberalization of the Rwanda economy. So Kenya, Uganda, Rwanda. And then in West Africa, Nigeria has been the leader by far on the West African side of things, followed very closely by Ghana. And then recently, we've seen a spate of interest in Francophone Africa, and those two geographies where tech has started to play a big role are Senegal and Cote d'Ivoire. At the Series A and B stage, there's been an explosion of interest in venture capital from funds and from corporates and family offices all across the world. And the trend is getting even more exciting today. So you've had several US funds, not just accelerators, incubators, and VC funds, but family offices and corporate venture capital entities like Google Ventures, like Samsung Ventures, like Microsoft Ventures. Goldman Sachs was involved in 3 of the biggest deals in African tech VC last year. And you see interest from corporate venture capital funds in Asia, India, and China, and Japan are making big strides in investing in Africa for lots of reasons, not just because of the market opportunity, but because valuations for early stage African tech and tech enabled businesses are lower than any other English speaking part of the world. And that valuation arbitrage, for lack of a better word, will not last forever. And that window of opportunity is really small. There were more than 250 global investment funds that have invested in African tech. And like I mentioned earlier, that's come from funds, from corporations, and retail investors. And that funding landscape is growing even quicker as we speak. The beauty of this trend is it's not just a trend from funds overseas. It's a combination of funds outside of Africa and on the African continent. What are the major tech cities in Africa? So like I mentioned earlier, Kenya, Nigeria, and South Africa are the 3 dominant markets for venture capital in the continent, with Nairobi, Lagos, and Cape Town specifically emerging as Africa's premier tech cities. The major tech hubs in Africa tend to be a combination of international and local incubators and accelerators. So the likes of Y Combinator, Techstars, Startup Bootcamp, which I'm the co-founder of, MLab, Nest, NILAB, Founders Factory. So you've got a growth in startup incubation, startup acceleration programs that have really spurred an interest from smart founders into building technologies of the future. And Nairobi and Lagos, together with Cape Town, have been the 3 dominant markets where this has started. So you've seen several examples of companies that are less than 5 years old and now serve hundreds of thousands of customers, both from a B2C perspective and a B2B2C perspective. I'll get into more specific examples of successful African tech ventures now. Like I said, more than $2 billion of venture capital funding was raised in the African tech space last year. So what are some of the key components that you as an investor or you as a partner should look up or look at when you look at a thriving startup ecosystem? So what makes a Nairobi or a Cape Town or a Lagos a hotbed for innovation? Number one, you've got to have talented tech-savvy entrepreneurs. And these are typically developers, designers, and digital marketers who come from top tier technical and business schools that are opting to pursue an entrepreneurial path by working with startup founders. So these are PhDs and master's students in science, engineering, and technology that choose to not become academics and instead go work as CTOs, CMOs, and chief design officers at startups. That's a trend that was seen in Silicon Valley 15 to 20 years ago, and you're seeing it in Cape Town. You're seeing it in Lagos. If you walk into the average coffee shop in Lagos today, you'll find tons of developers sitting and coding, building the next Jumia, building the next Amazon, building the next payment gateway. And because the population of these African cities is so large, Lagos has a population of give or take 20 to 25 million people. So there's room to build 3, 4, 5 mass transit solution apps, more than 5 or 6 payment portals, payment gateways. So because the demand for tech-enabled solutions far outweighs the supply of solutions, there is a bigger opportunity as a founder to create value producing startups using technology as a means. And that eventually drives funding into the sector. Secondly, you need risk capital. And I've used the word risk capital and not just capital because you need to understand that from an old school mentality, the majority of capital has gone towards property, which is real estate, investing in the stock market or in high capex intensive ventures. What we've now seen is there's a growing trend from HNIs, high net worth individuals, families, and venture back and VC groups that are gradually becoming aware of early stage VC instruments that are an alternative asset class, and we're seeing that gradually in tech hubs, but starting with South Africa and moving up north. Another very important thing is corporate startup collaboration. So typically corporates in Africa, and there are 5 major groups of industries to which startup collaboration is very important. Number one, telcos. Africa was where mobile money was invented. Africa is a birthplace of M-Pesa. So the big telcos in Africa, the MTNs, the Vodacoms, the Tigos, the Cell Cs of the world, telcos, banks, insurance companies, retailers, and media companies. The importance of these 5 major industries working with tech startups, not just from a CSI perspective, but from a corporate startup collaboration to look beyond internal innovation and product development programs by venturing into JVs, pilots, and POCs, proof of concepts, is what speeds up route to market for the startups and makes corporates a lot more innovative than they normally could be internally. The cost of innovating at a large bank or a retailer or an insurer in Africa is exponentially larger than partnering with a startup. So it's light on human resources, it's light on tech, and it's light on time. So corporate startup collaboration is another big factor that constitutes a thriving startup ecosystem. Then, of course, you've got the importance of accelerators, incubators, and high growth entrepreneurial support organizations that provide a channel and means for corporates to administer these POCs with startups. So the likes of, like I mentioned earlier, Startup Bootcamp, Techstars, Founders Factory, and then organizations like Endeavor, like Acumen, like Ashoka, and many others all across the continent that enable or create a safe sandbox where corporates can work with startups. And last but not least, it's very important to understand the role of government here. So we're not asking government to interfere, but to be willing, be red tape light at all levels, provincial, municipal, and national, to provide incentives to SMEs, small, medium enterprises, through things like tax subsidies or R&D grants to essentially help with funding enterprises through these R&D phases before they get to MVPs, which is minimal viable products, where early stage VC and angel funding comes in. So if you look at most cities like Silicon Valley, like Beijing, like Tel Aviv, London, that tend to be innovative tech cities, they have components of these 5 attributes that make up thriving startup ecosystems. And in Africa, Cape Town, Nairobi, and Lagos have very similar tenets that make them hotbeds for innovation. So it's very important as an outside investor understanding why these cities are ripe for entrepreneurs to work in. I'm going to touch upon a few things that are very critical when you look at VC investing in Africa. Like I mentioned, I've been investing. I'm one of the most active angel investors on the African continent. I've lived in South Africa and other parts of Africa for the last 10 years, and probably understand venture in Africa more than most people. So what are some of the things that make Africa a hotbed for innovation from a startup perspective? One is the importance of understanding your route to market. B2B business models work exponentially better than B2C business models. Why is that? Like I mentioned earlier, there is a massive game in the VC space where if you can understand distribution and channel and route to market, you will win. Unfortunately or fortunately, whichever way you look at it, there are certain gatekeepers to accessing customers. So those gatekeepers are telcos. Those gatekeepers are banks. Those gatekeepers are insurers. Those gatekeepers are retailers. And all across Africa, you tend to find 4 to 5 dominant banks, insurers, telcos, and retailers in every major region of Africa that have one very important thing: customer data. So irrespective of what your medium household income is, so you could be poor, you could be middle class, you could be rich, but you will always have a cell phone with a contract or prepaid. You'll always have some form of a bank account, be it mobile banking, be it real banking. You will always have some sort of an insurance product. Although the penetration of regular insurance as we know it, which is car insurance, home insurance, is not as high as in the West or other parts of the world, certain types of insurance, like funeral insurance, is very prevalent across Africa. So when you know that these insurers, and of course retailers with grocery cards and store points, formal and informal. So when you understand how you would like to scale a tech startup anywhere in Africa, and you understand that the only way to shorten your route to market and reduce your cost, and this is my next point, my cost of customer acquisition, which is my CAC, versus my CLV, which is my customer lifetime value. You have to be smart about how you acquire customers. And one of the most efficient ways to acquire customers on the African continent is by partnering with large retailers, banks, telcos, and insurers to effectively almost outsource your marketing and distribution to these large institutions. And how does it benefit them? Because you come up with an interesting or an innovative piece of technology that makes a large corporate more innovative, more disruptive to their clients, be them businesses or individuals. And by doing that, you effectively lower your cost of customer acquisition as a startup, and you outsource your distribution to them. Now, how do both parties benefit? Through revenue sharing agreements, through licensing agreements, through JVs, and in certain cases, through white label solutions. So a startup would build a solution that is used by a corporate, but it's white labeled in the sense that the startup solution is not seen by the end customer, but is powered by. So I could build, for example, a peer-to-peer insurance wallet that is only used and seen by the insurer's direct clients. And it's seen as that insurer's product, but it's actually powered by an insurtech startup. Like I mentioned, the key sectors that you as a startup founder need to look at are insurance, banking, retail, telcos, and media. And technology is obviously the largest underpinning of that. And the key understanding as a startup is, how do I grow and scale my business, and what is my most optimal ideal route to exit? So one of the things that I talk a lot to our startups, and we have more than 50 of them that we've invested in personally and through the different organizations that I represent, or how do you effectively do proof of concepts and pilots with large corporates? And that is a very important thing to understand, how you can get access to distribution very quickly. So instead of going in with selling a solution for a year, 2 years, or 3 years, and a big joint partnership, you look at small, light, lean experiments that corporates can test out in safe sandboxes internally. So there are several examples of this. It's called alpha testing, beta testing, but large corporates are very keen to see very quickly if an idea that they like works, and the ability to fail fast and fail often is something that corporates across the African continent are very much open to right now. The reality is the majority of exits in Africa still happen through corporate M&A. As a startup in Africa, you have to understand the R framework that I'm sure some of you have heard of. It's, how do I quickly acquire customers? Once I acquire them, how do I activate them? Once I activate them as customers, how do I keep them? How do I retain them? And then referral. How do I get them to be the best ambassadors for my product? And eventually understanding, how do I monetize the solution? So an interesting digression just for a couple of seconds is, if you looked at the most successful companies in the 80s and 90s, so before the internet, you would usually establish yourself either on the basis of price. So you either competed on price or you competed on quality, right? So you either had, you know, the elasticity of price or the abundance of quality, and you would differentiate yourself in the market by one of these two. Fast forward many decades later, in the 2000s and the 2010s, and as we move now into 2020 and onwards, it really just isn't about price and quality. It's about time. It's one of the biggest resources and the most scarce resources we have in our lives is time and convenience. That's why the abundance of sharing platforms like Uber, like Twitter, like Airbnb, like Dropbox, where you save people time or you make their lives more convenient, is often the biggest determinant of your value. And it's very important as startups, especially in emerging markets, to understand what drives user adoption. One of the most important charts that we see in our lives is, as startup founders, not just in Africa, but anywhere in the world, is, what is my valuation? And it has normally always been a funding of time. The assumption is, the longer you're around, the more valued you are, or the more funding I get, the more value I am. I've seen in my last 9 years of being in Africa, tons of startups that have been around for so long, but are worth almost nothing. I've also seen startups that have been around for a couple of months and are worth a lot. I've seen startups that have raised a lot of money, not worth a lot, that have raised no money and are worth significantly more. So the only thing that really determines what your true valuation is or can be is validation. Can I find the right product market fit and the right problem solution fit in what I'm doing? And that determines what my true valuation is. Let's talk innovation for a few minutes. The majority of innovation in the world, and a lot of this is courtesy of the great Clayton Christensen, the late great Clayton Christensen, the godfather of innovation, where people focus a lot on efficiency innovation. Efficiency innovation essentially enables companies to do more with fewer resources. That is, they make good products cheaper. Now, they're important in our economy because they help to maximize free cash flow. But efficiency innovation do not create growth. Because you're always trying to make things more efficient, it maximizes free cash flow, but it also causes you to minimize growth and job creation. So examples of this are outsourcing a firm's activities to take advantage of lower cost or lower wages using technology. Right? You then have sustaining innovation, which is the bulk of innovation globally, where you make good products better. So almost all the innovations we see around us today are sustaining innovations. So imagine that you're working for Toyota, and I convince you now that you will buy the Prius from me because it's more energy efficient. Now, what's going to happen? I'm not going to buy a Corolla or a Camry. If I sell you this year's product, you won't buy next year's product. So sustaining innovations allow us to make good products better, but they don't create any new growth. So companies rarely need to build new sales, distribution, marketing, and engines when they develop sustaining innovation because you're selling to an existing customer base, right? There's one form of innovation that is so rare to find, and it's mentioned in Peter Thiel's book that I would recommend you all read. It's called 0 to 1. It's called market creating innovation. That is the one innovation that creates a net growth for a corporation, for a country, for a continent. These innovations transform products that are historically so complicated and expensive that only rich people had access to them. But a market creating innovation transforms them into products that are affordable and accessible so that many more people can own them and use them. Two really good examples of this are Singer, that made the first sewing machines. When the first sewing machines were developed in the early part of the 20th century, people would spend hours, days, weeks to make a single shirt, a single pair of trousers. Isaac Singer, that built the sewing machine, had no idea on what the eventual impact of this would be on the world. But what's interesting about market creating innovations is, like I mentioned earlier, it creates markets when none existed before. So when you could reduce the time it took to make a dress or a piece of clothing material down from days to hours, you created a demand for products that didn't exist. The wardrobe industry, the fashion industry, the furniture building industry came about as a result of the demand for clothing simply because it could be done quicker, faster, and cheaper, and eventually more affordable. The person on your right, your bottom right, Henry Ford. Again, cars were the domain of the rich and the wealthy. But remember, when you pull things into your supply chain and you create jobs and opportunities for everyone that almost leeches off of you, by building a car that could be used by the masses, you created the need to build roads, to build petrol stations, to build service centers. So you look at, as an entrepreneur and as an investor, you want to look at entrepreneurs. And this is why it's so important when you look at entrepreneurs in Africa, is you want to look at entrepreneurs that are building things that create a secondary and tertiary demand for products that fuel that industry. Coming back to Africa, just two very simple examples of how this can really perpetuate and grow. In the 1980s, we had a group called Tolaram that introduced in Nigeria this concept of noodles, chicken noodles, beef noodles, you name it. So just literally flour and maize. But in a population where traditionally noodles were just not considered food, they got flour imported from Southeast Asia, from Indonesia specifically, and introduced it into the African market. But it was cost effective. It had a lot of protein. You could get a meal as a Nigerian in the 80s and feed your family. It was healthy, sustainable, and cheap. But what's interesting, what the Tolaram Group did is not only did they look at selling this to consumers, they built a backward integrated supply chain that made it possible for people to take advantage of this. So they built roads, distribution centers, transportation logistics. They owned the entire supply chain. So instead of outsourcing it to logistics providers, to trucking companies, they built their own trucking companies, their own distribution centers. They built a port in the south of Nigeria to get better shipment of goods from across the oceans. They built training centers to train people. They built translation language centers to make it more effective to communicate to different language groups in the country. So it's this backward integration that makes it so much more lucrative when you're looking to invest in companies. So you really have to take time to understand a pull strategy versus a push strategy. As in, I'm not trying to force you to buy something. I'm pulling you into my enterprise because I'm creating value for you and hundreds of other people that depend on you as a result of your innovation. Microinsure is an innovation in the insurance industry in Southern Africa. Most people in Africa cannot afford the cost of insurance, and they view insurance as a grunge purchase. Microinsure solved that problem almost a decade ago, where they said everyone in Africa has access to a mobile phone or has a telco account. So hundreds and thousands of patients could not access private healthcare because they just did not have the affordability to pay these premiums. But what if a mother with a sick child was given a guarantee that if her child was sick, she could walk into a hospital and have her upfront cost, aka her premium, paid for her first visit for free, but it would eventually be taken off of her airtime or her data purchases from her telco. So she wouldn't effectively see it, but she would see it as a reduction in her telco bills. Now, what that's done is it's created this entire market for insurance, for medical insurance, for life insurance, for any sort of insurance in a region where there was no demand for it because they understood how to pull people into it by partnering with a telco. So we see these similarities between innovations today versus what happened almost centuries ago with examples of Singer and Ford. So what do we do in Africa? We are a global accelerator founded in 2010 that operates industry-focused startup accelerator programs in 19 cities across the world. We call Startup Bootcamp. We are one of the top 5 accelerators in the world. We focus on very specific industry verticals like FinTech, InsurTech, cybersecurity, commerce, smart cities, etc. And we accelerate more than 200 startups every year. Myself, I'm the co-founder and responsible for the Africa operations. We essentially help get these startups investment ready, market ready. We partner them up with the right insurers, banks, retailers, and telcos to help them effectively scale across the world. So we typically condense what normally takes them 2 to 3 years down to 6 to 9 months. So we've now collectively invested as an organization in more than 830 tech startups across the world. 78% of them are still active today. And the average funding that they've received post our program, and almost 2/3 of them have raised a price round post of our program, that average funding is just over €1 million. But what's really impressive is the success rate and the operational longevity of these startups. Only 20% of these companies have folded or have not gone past the first 2 years of their operations. And it isn't magic. It's because we really understand what corporate startup collaboration looks like and what effective scaling is. We have a less than 1% acceptance rate into our programs, and we are very, very clear about how we scale companies globally, within Africa and outside. So Startup Bootcamp is one of the best accelerators in the world. And from an African perspective, we see the importance of partnering with similar accelerators and incubators all across the continent as a key means to scale companies, and create world-class innovations from Africa for Africa. As a next step beyond running a successful accelerator, which we've done now for more than 5 years, I'm now in the process of launching the first ever Pan-African fund that invests specifically in B2B and B2B2C early stage startups. There is a huge problem from a funding gap perspective, where there are very little friends and family investors and limited angel and seed investors in Africa. There is a lot of interest and focus in incubators and accelerators where you can accelerate ideas to MVPs. That's where organizations like Startup Bootcamp and YC and Endeavor and support organizations help in incubating ideas. There is then a massive gap until you get to Series A. So at Series A and beyond, there is a plethora of VC funds, family offices, DFIs that invest in African tech startups. The average valuations is a very important thing. The average valuation of a tech startup at the seed stage in Africa is around the $1 to $2 million mark. But once you get to Series A and you have established pilots with large corporates or clients, the average valuation for a FinTech or an InsurTech or a smart city startup or an AI-powered big data startup is anywhere from a minimum of 10 million to as much as 30 to 40 million dollars. So that gap between seed and Series A is usually anywhere from a 7x to a 20x increase in valuation. And then beyond Series A, when you get to Series B, the bump is a lot less. So your Series B valuations tends to be anywhere from 50 to 200 million. I'll give you specific examples of this in a second. So the gap really is between seed and Series A. So Launch Africa Ventures, which is a recently launched fund in Mauritius, has a targeted size of $15 million, and we're looking to invest in specific African tech companies that are between seed and Series A, which is where the biggest funding gap opportunity is. One of the big concerns that LPs or limited partners have in emerging markets like Africa is how long their capital is locked into businesses. So most LPs in African VC funds tend to have 7 to 10 to 12-year lock-in periods where you have to wait until successful exits happen. And exits on the African continent tend to be mostly, like I said, corporate M&A and occasionally, very, very, very rarely, a listing. But what's really important is because once you get to secondary and tertiary funding rounds, the opportunity for early stage investors to exit at future priced funding rounds for oversubscribed rounds is a very important, credible way to look at liquidity for LPs. One of the things I wanted to briefly talk about is the concept of how you invest in early stage companies in Africa. So instead of looking at priced rounds, one of the best and smartest ways of investing in companies is through either convertible notes or safe note. Because the reality is it is very, very hard to look at valuing an early stage tech startup, not just in Africa, but anywhere in the world. So all our investments will be done through safe notes at a 50% discount the next priced round. We invest small amounts of money, up to $200,000, $200,000 to $300,000 per deal, and we look at exiting our stakes at the immediate next price round at Series A and Series B, taking into account the big valuation gap in seed funding in Africa. Some of our top returns, both in my personal capacity and through Startup Bootcamp, and through other investment entities I've made. These are just examples to give you a perspective of the opportunity. So all of our investments have been done at the seed or the angel level. mPost is a great example of a technology that is so relevant for the African continent and may not be relevant elsewhere, but has a huge market opportunity. mPost is a logistics company in Kenya that converts your mobile phone number into a virtual postal address. So there are more than 40 million people in Kenya with only 400,000 physical post boxes. And because you don't have a concept of a postal delivery or a postal door-to-door delivery anywhere in Kenya, people use fake post boxes. People share post boxes, and that's a fraudulent practice. So what they've done is they've partnered with telcos like Safaricom and Telcom in Kenya and they have a patented piece of technology that converts your mobile phone number into a virtual post box, where if you have post delivered to you, your address simply is your phone number together with your closest zip code. So you can redirect your parcels to the nearest post office, and you could either pick it up yourself or have it delivered to you at a charge. We invested in mPost when they were part of our accelerator at a valuation of $250,000. They've now, barely a year and a half later, raised their Series A at a valuation of 10 million. That's a 40 times increase in valuation in just under 2 years. Again, plenty of examples. I'll give you an example of a FinTech company, Flutterwave, which is one of the top payment infrastructure companies based out of Nigeria, but operating out of Silicon Valley. The target market is the African continent. It allows merchants and institutions to pay and be paid across multiple payment methodologies, cards, wire transfers, mobile money, etc. And it facilitates cross-border payments between any African merchant or client and overseas institutions. They went through Y Combinator in 2016, where their valuation was $10 million, and they've just done their Series B in early January 2020 at a 20 times multiple, again, in 3 years. I can go through a lot of these companies on our list. These are all companies that we've invested in. Just reiterating the point that early stage investing in Africa provides you an incredible opportunity to take advantage of depressed valuations at earlier rounds and a huge intake and interest in valuations on companies at the Series A and Series B round. You, like I mentioned a bit earlier in my presentation, you've had more than 250 VC funds and corporate VC entities that have funded African tech startups at the Series A and Series B level. You've probably heard of companies like Sendi in Kenya, which is logistics, Lorry, Uber for trucks, again in East Africa, Kobo 360, a smart city solution based in Nigeria. All these companies have raised north of $10 million with investors like Google Ventures, Goldman Sachs, Sequoia Capital, that have understood that the African tech and impact investing sector is not just a feel-good story. It's a very, very lucrative story from an economic standpoint. These are just a couple of case studies of two companies that I wanted to highlight. A fintech company in Nigeria, I mentioned Flutterwave, that provides technology and infrastructure services to enable merchants and payment service providers to pay and get paid all across Africa. Again, the valuation uptick from 2016 when they were part of Y Combinator to where they are today, and where they have announced a partnership with Alibaba's Alipay and a partnership with WorldPay just a few months ago. It just shows how successful B2B partnerships can really change the valuation landscape. I mentioned mPost earlier. Again, similar massive valuation uptick in just under under 2 years. So what's important to understand here is if you can identify technology companies that are using technology to solve real world problems in education, in healthcare, in agriculture, in food and water security, in energy, that is where the biggest bang for your buck comes as an early stage investor. And we have several examples of this. These are some examples of fintech and insurtech companies that we've had in our portfolio: digital banks, community lending platforms, savings clubs, on-demand digital insurance solutions, card readers, um, claims management software. The key thing is understanding how can you use software as a service to reduce inefficiencies, to improve the speed of transactions, and to save money. KYC, know your client, identity, all these, and how can you use robotic process automation to make processes quicker? Again, just re-highlighting how important it is to be able to understand the B2B aspect of investing in tech companies. I'm not going to go through all of these, and these slides will be available on this website, but these are just a small subset of examples of companies that have gone through our programs that I've invested in personally, and we are now formalizing this through a Pan-African seed fund that we would welcome interest from parties anywhere in the world to be involved with. And as I often like to quote the great leader of South Africa, it always seems impossible until it's done. Africa is going through an incredible revolution in the technology space. As much as large corporates and governments can try to create jobs and employment and improve the GDP and lifestyle of people, what really, really creates value is building entrepreneurs and using technology as a means to do that and to create significant value from an economic perspective. So if you would like to know more about the state of venture capital in Africa, how it's grown from 20 million odd to $2 billion in less than 9 years, and what you can do as a prospective investor to be involved in that and to help in this journey, you can reach out to me on Twitter or on my email or my number on WhatsApp. I'd be very happy to talk to you. Thank you for listening to me and have a good day.